Welcome to our latest urgent market update video. Now, this is Tuesday, the 13th of June, 2023, and the title of this video is just making the statement really that this is probably the most significant trading week of the year so far. So it is important to be very mindful of these major news events. We'll go through them one at a time over the course of this video. And more importantly, we will just make some initial observations in terms of what the market is likely to do in response to these news events. And that's where we'll be able to plan and prepare our trades, bearing in mind whether a lot of these news events come in line with expectations, whether they exceed expectations, or they come in below expectations. So without further ado, let's get straight into it then. We'll start, of course, with our animation. Okay, so just before we begin then, we'll start, of course, with our risk warning. Please take a brief moment to familiarize yourself with our risk warning currently up on screen. And as always, be very mindful of the risks involved in trading financial markets, especially during really quite choppy and broadly quite mixed. Okay, we've had a bit of a relief rally across the equity markets over the last couple of days. Well, basically from Friday evening. And yesterday evening as well, we saw again some further upside across these equity markets. So the question is that market condition likely to continue? So with that in mind, let's get straight into it then. We'll of course have a look at these news events just one at a time, and we'll position ourselves accordingly. So today's Tuesday, the 13th of June, and really our focus is at lunchtime today, which is headline CPI numbers are expected to come in considerably lower than the previous month. So previously we had a 4.9 inflation headline inflation number. We're expecting 4.1. So these are all the analysts with all their considerable might and know-how are suggesting that CPI headline CPI numbers are likely to come in around 4%, 4.1%. Core inflation seems to be a little bit stickier than headline, as you can see. We're interested to see if there's going to be a differential between headline and the core. Core just excludes food and energy prices. So really worth seeing if there's a differential there. And month on month, it looks like there's a bit of a softening on the headline rate, which feeds into this 4.1%. So really, we want to see if these markets, if this particular news event today at 1:30 p.m. comes in line with expectations, then we'll probably see some further upside across the equity markets. We'll probably see a little bit of weakness in the US dollar. If it comes in lower than expected, we'd probably see an outsized bullish move across the equities and further dollar weakness across the board. And we'd probably see a considerable amount of volatility in that direction, we would assume. Now, here comes the tricky bit. If inflation comes in above expectations, i.e. inflation is stickier, stronger than the markets expect, then that might lend itself to a bit of a surprise rate hike on behalf of the Fed. So this is where tomorrow's federal funds rate decision comes in, and we'll get the dot plot tomorrow, as in Wednesday, the 14th of June. And this news event is at 7 p.m. We will have producer price index, so input costs. We get that inflation, and that looks to be improving quite considerably as well. So at the minute, these markets are certainly pricing in considerably improved inflation numbers across the US economy. So on the surface, that does mean that the Fed are getting a lot closer to achieving what they're trying to achieve. And it was anticipated, going from 9 to 5% was going to be quite easy, quite straightforward. Going from 5% to 2% was going to be the challenge. And a sizable move from 4.9 to 4.1 definitely is kind of a third of the way, pretty much, and would be quite an impressive response from these markets. So all of these inflation numbers feed into this federal funds rate decision and the press conference. It will be interesting to see how Jerome Powell handles. He's been talking out both sides of his mouth for well over a year now, and he got the whole sort of transitory inflation picture completely wrong. So it's going to be interesting to see whether it's a skip, whether it's a hawkish skip, whether the markets perceive the rate, pause as a bit more of a longer term pause. So there's so many different variables really to how these markets are likely to respond to a potential pause from the Fed. And the first step in a three-step process is very much today's CPI numbers, consumer price index numbers. The second step would be tomorrow's input costs for producers. Is that going up or is that coming down? And the third step would be the federal funds rate. And then we'll finish off with the press conference. So we did say that this would be the most pivotal probably trading week of the whole year. And we truly believe that's the case, because this is the first time that the Fed are potentially pausing. And the problem is, year to date, if we look at the markets like the S&P 500 in the US, like currently up on screen, prices since the beginning of this year have gone from bottom left to kind of top right. And we're in a bit of a technical bull market as well. Now, if you zoom out, you'll see the potential for, again, some further downside moves. But right now, with the potential really positive inflation numbers coming through, meaning that the Fed are probably likely to pause at 5.25, then that is potentially kind of a bullish signal for these markets. And these markets are really reacting accordingly in the build up to that news event. Now, things can change as soon as we get these CPI numbers. So we're not necessarily taking for granted, or we're not discounting a downside move at all. If it comes in, if this inflation number today on the consumer side comes in at 4.3, 4.4, 4.5, then inflation is not coming down in line with expectations, and that would cause a bit of a concern. And potentially the Fed could come forward with actually a rate hike, and that would surprise markets, and that would be quite a bearish move. So I'm sure the Fed are not overly happy with this bullish, very excited rally that we're seeing across the indice markets. That doesn't really have the impact of tightening market conditions. It has the opposite effect of loosening conditions. And this is not really what the Fed are trying to achieve. They want to bring down inflation, but they are waiting for those rate hikes to feed through the jobs market, to feed through the economy. We'll probably at some point start to see an impact across earnings in the US. And then it becomes a bit of a trade-off between whether we'll see a soft landing or a hard landing in terms of a recession, because there is a recession coming down the line. That must be said. When you have inverted bond yields like we're currently seeing, the difference between the 2 and the 10-year is quite significant, and it seems to be growing recently as well. So you're looking at a 75, 80 basis point differential between the 2-year, which is higher, and the 10-year, which is lower. It just shows a bit of near-term concern, and it looks like we're pushing back up to that 5% mark. So all is not well, but certainly the equity markets during periods of kind of lower volume and volatility are certainly progressing to the upside. And we're seeing that across the equity space. We're seeing that across the NASDAQ, the Dow Jones is seeing further upside, and same situation with the NASDAQ on the daily time frame. We're up at elevated levels. So, and we're seeing, the potential for some further upsides beginning to roll over a little bit now. A little bit of caution is beginning to creep in. If you look at the Nikkei, for example, with the selling we've seen in the yen, considerable selling we're seeing in the yen, we're seeing an upside move across the Nikkei, and it just seems to be continuous constant upside. Very little opportunity to get in on a proper coherent pullback. You're getting a couple of days of selling, and then you're seeing further upsides. Bitcoin is going to be an interesting one to watch. We're just trading around that sort of $25 level, $25,000 level. We'll see if there's further upside in the equity markets. Will that follow through across the equities? So, and the other sort of element to these markets, and a couple of little quick observations to make, is that we are still in a consolidated fashion in US oil. Yes, the bias is still to the downside, but we've been range bound between $67 and $73. So there's been a $7 range in oil since early May. So a bit more progress to be made in that respect. And then if we look at gold, you can see that, you know, we've certainly rolled over to the downside quite considerably. We're trading at these lows here around strong support levels. So if the dollar starts to weaken, we might see an upside move in gold. So keep an eye out for that. And it's really, not only will we be looking for the indices higher, depending on these inflation numbers. If they disappoint, we're looking for the indices lower and potentially for the dollar to strengthen. So this is a lot of the price action that we're seeing in the build up to this CPI number seems to be by the rumor, and we'll see whether it's buy the fact or sell the fact. And that could be the deciding factor in terms of whether we're net buyers and net sellers of the equities, and we would look for the upside down move in the dollar. So equities higher, dollar weaker. So the euro dollar to the upside is what we'd be looking for. Potentially pound for further upside. A lot of these markets are kind of, they're in a bit of a holding pattern. So we've not really seen the explosive move in the dollar weakness trade that we've seen in the equity space. So there seems to be more of a focus on the moves that we've seen in the equities. This little impulsive move. Now the timing of these moves are really quite interesting. If you go back and look at the charts, you'll see Friday, sort of late afternoon, early evening, we saw the move kick in Friday afternoon, and over the course of the evening, in the latter part of the trading week, of course. And then again last night we saw further upside moves, but it was again in the latter part of the trading day, i.e. the European markets are pretty much closed, and a couple of hours into the latter part of the US trading day, we saw some further upside. Okay, so really, and I suppose the other thing that we kind of want to highlight is that it's not just a dollar-based trading week. The focus shouldn't just be on these inflation numbers and the FOMC, although that will be by far the most impactful news event of the trading week. The other thing to keep an eye out for is that we're going to be hearing from the ECB on Thursday, and not to be forgotten about the BOJ on Friday. And how we can use and interpret that is look for differentials in central bank monetary policy rates between all your major global central banks. And do keep an eye out for the yen. Will they surprise markets maybe with perhaps loosening their yield curve? Will we see we begin to move off this negative territory for the Japanese economy? We'll have to wait and see. The Nikkei is absolutely flying at all-time highs. But it's this differential. Will the Fed pause at 5.25? Because we know the ECB, the RBA, the BOE, the BOC, the RBNZ, they'll all be looking to still push rates higher, which may lead to further dollar weakness. So we'll have to see further upside in the euro dollar, further upside in the pound dollar, further upside in the Aussie, New Zealand dollar, and dollar CAD to the downside in favor of the CAD. So we'll have to see how these central banks play out with their monetary policy. But what we're anticipating with all of these major news events is some, hopefully, really considerable volatility over the course of this week. And what we're looking for as an organization is coherent volatility. So we want things to start making sense, because certain aspects of any move you want to look at, whether it's indices, there's definitely red flags, even though we see prices pushing higher. So today's CPI numbers are going to be very, very important. It's the first phase of kind of 3 phases really before this market will make its true direction known. So just because we've got some very significant buying in the build up to today's inflation numbers, it doesn't mean that if we disappoint and inflation comes in a bit higher than expected, you'd probably see a strong corrective move in this market. So very difficult markets to trade currently, but we're waiting for that either green light for further upside or potentially for that very considerable rollover, which wouldn't be too far away from these markets either. So we are tentative buyers. We're a little bit more, we'd be a little bit more, let's say, proactive with some selling if some selling creeps in. However, today's and tomorrow's news events could change all of this. So it's a case of just kind of watch this space at this time. Currently, if you're looking at these markets, you might have a bit of a rate pivot in mind, or this skip or pause, whatever you want to call it, has a bit of a dovish impact. If you look at historical interest rate, when prices pause, they generally pause for a period of time before they start lowering. So that rate pivot may become a bit more of a reality, especially if inflation gets under control. But currently, we're in this little risk-on phase. Indice markets certainly pushing higher. Dollar is certainly in the process of selling off. However, bond yields are continuing to push higher, not lower, and commodities are rolling over to the downside as well, and they should be, kicking on to the upside quite considerably. If you happen to be, and this is why we refer to it as narrative tennis, if you happen to be on the hawkish side, we might get a hawkish skip from the Fed tomorrow. Rates might stay higher for potentially longer, and core inflation might remain sticky. And still, if you look at bond yield inversion, you would suggest that a recession is coming. Except right now, we don't have risk-off conditions. The indices are not rolling over, and the dollar's not strengthening. So we don't really have opportunities to get in on that risk-off trade currently. However, interesting to see is that we're currently seeing bond yields push higher and commodities continue to roll over to the downside. So as you can see, there's conflict built into these markets, and this is why we call it, you have to make a decision whether you want to be on the risk-on side or the risk-off side. The last few days, it's been profoundly risk-on. In fact, we've had a bit of a risk-on mentality during tough market conditions for the majority of this trading year. Now, that will unwind at some point. I'm sure there'll be a corrective move at some point, and we'd certainly be a little bit more enthusiastic about that than getting in to the US indices at these excessive highs. Now, the dollar weakness trade could be, a really very important trade to keep a focus on. So, with all this in mind, we appreciate you might have some questions about things covered, because there's a whole variety of different potential variables to take into account and potential outcomes as well to consider. So yes, it is quite confusing currently. If you're struggling and trying to grapple with these markets, we're in exactly the same boat. A lot of traders out there are. Some of these moves are very, very shallow in terms of market breadth, in terms of participation in some of these moves. So definitely a challenging environment out there. If you do have any questions, feel free to email us at support@thelivetraderoom.com. So on that note, thanks very much for joining us. Do stay tuned for our next video. We'd probably be getting a video out, I would imagine, towards the end of this week. So in a few more days, we'll probably be getting another one of these videos out. I'm sure we'll have an awful lot to say about these news events and also how we perhaps have been trading them and how we will continue to trade them in the coming days. So just to let you know, we do broadcast our trade plan sessions every morning from 7:30 a.m. And we do trade these markets fully live and interactive, 8 a.m. every single morning for the European session, Monday to Friday. And we're back again broadcasting from 12:45 p.m. these are all UK times, by the way, for the US trading sessions. So If you want to join us for that, you're very welcome to do so. For more information, just go to our website, thelivetraderoom.com, and feel free to connect with us there if you need. So from everyone here at the Live Trade Room, thanks so much for joining us. Do take care, and we do look forward to speaking to you again, perhaps in the coming days. So watch this space, and we'll speak to you soon. Bye for now.